In this video, I will show you everything you need to know to become a profitable trader in 30 days. We will discuss why traders lose money and how to flip the script with a simple proven strategy with an edge. I will show you literally everything step by step. So the main reason traders fail is because they don't have an edge. An edge is anything that gives you a statistical advantage. And in trading, this can be seen in your account balance. In example 1, you can see that the trader has a strong edge and his account balance consistently grows. While on the second example, you can see that it's flat and this trader clearly doesn't have an edge. A good example of this can be seen in a coin flip. If you win $1 when it lands on heads and lose $1 when it lands on tails, and we know for a fact that the odds of it landing on heads or tails are 50-50, so if you keep doing this long enough, you won't be making any money because there is no edge. Now imagine if you would win $3 instead of $1 when it lands on heads. Now your 5 wins total $15 and your 5 losses total only $5. So 15 minus 5 is $10 profit. This simple concept is what all profitable traders use to their advantage, with no exception. Because trading is not a game of strategies and drawing lines on a chart, but a game of probabilities. And you want the probabilities to be skewed in your favor as much as possible. So let's take a look at how this applies in the real world. Here you have a simulation of the 6 most recent trades a losing trader has taken. And by looking at the profit and loss of each trade, you can see that his average loss is $100 and his average win is also around $100. And if you count all those trades up, you end up with a loss of $100, which tells us that his strategy has no edge. Most traders use a risk-reward ratio of 2, 3, maybe 4. Those are the common ones. But if you take a look at his trade, no trade is bigger than $140, so he never lets his winners run. And as soon as he saw profits, he decided to close the position early, which as you can see did more harm than good. If he were to continue trading this way, he is guaranteed to lose money. This is what losing traders experience all the time, and so did I for the first 3 years of my trading journey. But the good news is that there is an easy fix to this issue. Here you have a simulation of the 6 most recent trades a profitable trader has taken. Unlike the losing trader, we can clearly see consistency here. All of the wins are $300 or 3 times the risk. Both traders have exactly a win rate of 50%, yet one is losing money and the other one is consistently making profits. And you might ask yourself, this is too simple, there's no way this is the secret to profitability. Well, it actually is, because applying this correctly is the difference between consistently being profitable and consistently losing money. Because if you apply it correctly, you have an edge. So how do we go ahead and apply this? Well, let me tell you, you're in good hands, because I will show you exactly how to do it step by step in this video. We will go over my strategy, which I have developed after testing 70 strategies in the span of the last 4 years. And this is the only strategy that has consistently worked for me. So I will show you everything in this video. So let me introduce you to the golden breakout system. This strategy is so simple, you will be able to understand every aspect of it in the coming minutes. Most educators hide behind complex strategies, and not because they work, but because they want to sound smart. But this system is so simple, you can execute it perfectly, unlike those 5-minute strategies that those educators promote. We will go over the rules of this strategy, and then right after that, I will show you live examples. This strategy consists of 5 simple and very clear rules. The first one is to only trade stocks that are up 50% or more in the last 12 months. The second one is the stock needs to be above the 200-day moving average, and then you need to wait for a breakout on the daily time frame. And then the last 2 is to use a 3-to-1 risk to reward ratio, and finally your stop loss needs to be 3 times the ADR percentage. Now ADR means average daily range percentage, and this is basically how much the stock moves in any given day on average. So that's why I like to use it, that way I don't have to guess how big my stop loss needs to be. But no worries, everything will be clear in the coming examples. So rule number 1 is to only buy stocks that are up 50% or more in the last 12 months. This makes sure you only trade stocks like in the first image, which I call fast moving stocks. And as you can see in the image, it's very easy to enter a trade and to also have a winning trade. While on the second image, you can see a slow moving stock, and this is the type of stock you want to stay away from at all costs. They move slow, they chop around for months, and sometimes even years. And it's hard to enter a profitable position here because the trend changes all the time. By looking for stocks that are up 50% or more, we automatically filter out the bad stocks, because the stocks that you can see in the second image, those stocks rarely go over 20 to 30% in any given year. Rule number 2 is to use the 200-day moving average to determine the trend of a stock. And after testing tens of indicators, the 200-day moving average is literally a cheat code when combining it with fast-moving stocks. But on the flip side, on slow-moving stocks where there is no clear trend, but the price is just ranging for months, the 200-day moving average is not effective because there is no clear trend. So now, let's take a look at some real-life examples. This is the chart of the stock Netflix on the daily time frame. And as you can see here, when price is above this blue line, which is the 200-day moving average, price tends to continue in that direction, meaning when it's above 200-day moving average, it continues to go up, whilst when it's below it, it continues to go down. You should only go long a stock when it's above the 200-day moving average. That's why I have it in my rules. And now if we go to the next stock right here, Palantir, the exact same thing. When we were below it, we continued going down, so we were clearly bearish. And when we were above the 200-day moving average, we went up. And this is as simple as it can get. You don't need to draw any lines or nothing. The only thing you need is the 200-day moving average, and that determines the trend for you. So you will never have, like, for example, see this as a trend change, meaning that you're now bearish or whatever. The only thing you use is the 200-day moving average. And now, rule number 3, which is to buy the stock on a breakout on the daily time frame. This is the only entry model we use because it is very simple, easy to learn, and extremely effective. It doesn't require any support and resistance, Fibonacci, or anything else that's complicated. Just a line to be broken, and breakouts on fast moving stocks have a 70 to 80% success rate. Rule number 4 is to use a 3-to-1 risk to reward ratio. I have tested many different risk to reward ratios, like a 5-to-1, even a 10-to-1, but I found that the 3-to-1 is the most consistent. It is favorable on all sides. You need just a 25% win rate to break even. And if you only manage to have a 50% win rate, then you are still extremely profitable. So let's take a look at this example here. You can see that in this case we have 7 losing trades and 3 winning trades. This is a bad win rate, but I put it here to prove a point. Respecting your risk to reward by letting trades hit both your stop loss and take profit are extremely important. With a 3-to-1 risk to reward ratio, we walk away with a profit even when we get unlucky and have a 30% win rate. When you look at trading from this lens, you can see that it's not so hard to be profitable. My win rate over the last 12 months using this strategy is between 60 and 70%. But for the sake of the example, to keep things simple, I will use a 50% win rate. And even with a 50% win rate, which is extremely realistic, it doesn't take a genius to have a 50% win rate, you can see that this strategy has a strong edge. The reason most traders can't follow the rules is because the rules are extremely complicated and the trader doesn't believe in the rules deep in his core. But this strategy is so simple, you can be certain that when all these 5 rules are met, you can confidently enter the position, and over time the edge will play out, which will mean that you will make profit over time because it's so simple to follow. And finally, we have the 5th rule, which is that our stop loss needs to be 3 times the ADR percentage. This rule will give you clarity and confidence because you don't have to guess what your stop loss size needs to be. You just take a look at the ADR and you multiply it by 3. I have an example here of a stock which has a 3% ADR, which means that the stock on average moves 3% a day. So our stop loss needs to be 3 times 3, which is 9%. So our stop loss needs to be 3 times 3%, which is obviously 9%. So now that we have been over all the rules, let's go to the fun part. Now we're gonna go ahead and apply them on real life examples. Let's now take all those criteria and apply it into a real life example. Palantir is a stock that met all those criteria in 2024, so let's analyze it step by step. I went ahead and marked the start and the end of 2024 because that's the most recent full calendar year that we have. And if we go back to the golden breakout system and look at the first criteria, it says the stock needs to be up 50% or more in the last 12 months. And if we go to this particular moment in 2024 and we analyze, you can see that the stock at this particular point was up 181% above its 52-week low. So in the last 12 months, it's up more than 181%. And this is a perfect example of a stock that we want to trade. So we don't want to trade stocks that range too much. We want to trade stocks with momentum. So our second criteria is the stock needs to be above the 200-day moving average. And as you can see, the stock clearly is above the 200-day moving average. And I use this one because I feel like it's very powerful at assessing the trend, because you can see when price was below the 200-day moving average, it consistently went below it, and there was no need to buy the stock below the 200-day moving average, because it meant that as soon as you buy it, you would be in a loss. Compared to when the stock is above it, it's a very good idea to buy the stock because it's very likely that it will continue going up. But nevertheless, let's now go to the third criteria, which is to wait for a breakout on the daily time frame. And as you can see, I'm on the daily time frame right now. And if we draw a breakout right here, you would see that we need to break this line for us to enter a trade. So let's go ahead and fast forward until we do. And there we have it. At this particular point, our third criteria is met. So now our last two criteria, which is to use a 3-to-1 risk to reward, and our stop loss needs to be 3 times bigger than the daily ADR. So let's do that. First of all, let's enter the trade. You should have entered during this particular candle. Let's just say we entered in the middle. And now the ADR basically is 4%. So our stop loss needs to be a minimum of 12%. So let's take 4.07 times 3. That is 12.21%. Me personally, I like to be very precise with this because I don't want to really make any executional mistakes. So 12.21 is what it should be. 12.25, that's not bad either. And now a 1-to-3 risk to reward ratio. And now if we go back a final time to the golden breakout system, you'll see that we applied every single thing of those 5 criteria. And now let's let the trade play out and see what happens. You actually could have added a second position here, but for the sake of this example, we won't do that. But you can see that the trade went to our take profit, and it was a winning trade, right? Now let's just say, because I showed you now an example, we do this for the remainder of this period to see what the actual win rate is. So right here we had a breakout, right here we had a breakout. You could say right here we had a breakout, and then the next breakout was here, but that was 2025. But you get the point, right? When you find a stock that meets all of those criteria, that's basically it. You have your ticket. If you follow all of those rules, have good risk management, do everything correctly, it's very unlikely that you will lose money, because going back to the equity curve simulator, this strategy has an edge. If you remember this, when you have a 65% win rate, a 3-to-1 risk to reward ratio, this is what your equity curve should look like. And when we look at the examples, and you see here a win, another win, another win, another win, you rarely take losses. And I will not just show you Palantir, I will show you many other stocks and show you examples, but you get the point. Do you see how simple this is? Like, it can't be more simple than this. It's on the daily time frame, yes, and yeah, let's discuss that actually now. Why do I use the daily time frame? Because this is a question I get often. Let's now remove all of these drawings, and let's go, for example, to the 15-minute chart. Let's see if that's possible. Let me remove this EMA. But do you see how chaotic the chart becomes when you go to the 15-minute? There is this going on here, this. There is no order anymore. And I might go into this into another video. I won't do this now, but this is a mess. It's really hard to read. Like, we break lows, highs, support and resistance. This is way too random. And the reason why I use the daily time frame is because every single candle is 24 hours. It's a whole day compared to here where every candle is 15 minutes, and a lot of random things can happen in such a small time frame. So that's why I use the daily time frame. So now we will analyze even more stocks by taking the criteria from the golden breakout system and applying it into 3 stocks: Netflix, AppLovin, and Axon Enterprise. And what we basically will do is we will once again analyze a full calendar year to see how this strategy would have performed. So let's start off by Netflix. First, what we need to do is we need to go to the beginning of 2024, and you can see that this particular stock is up 64% in the last 12 months. And so this is a stock where we have now the green light and can go ahead and trade it. To keep it simple, what I'm going to do is I'm going to start at the beginning of 2024, and I will mark all the places where we had a valid trade setup. So the first one is right here. We should have bought here because we have a breakout on the daily time frame. The next valid setup would have been this one right here, where we had another buying opportunity. And the next one would have been this breakout right here, as it has 3 touch points. And then the next one would have been this breakout right here, with the buying opportunity being here. And next up, this one. And finally, I think this is the last buying opportunity of the year, and that is this one right here. So if we take a look and count all of the trades, we have 1, 2, 3, 4, 5, 6 valid setups across the whole year. And you can see that all of them, after every single trading setup, the stock continued to go higher. So that's because the golden breakout system is designed with one thought in mind, and that is how to keep the win rate as high as possible. And the end result is the following criteria here. Now we'll take a look into the stock AppLovin, which was also a very big winner in 2024. So let's go ahead and go to the beginning of 2024. And as you can see, the stock at this particular point was up 314% from the 52-week low. So it's up over 300% from this point. And so this is a very valid stock that we can go ahead and trade. And so let's go to the beginning of 2024, and you can see that the first trade was right here, which immediately was a winning trade. So let's go ahead and look for the next trade, and here it is. So this is the first losing trade that we encountered with this strategy. Like, obviously every single strategy has winners and losers, and this strategy is right pretty much 70% of the time, but you can see that the losses are very uncommon and that you have way more wins than losses, because strategy is built to be as profitable as possible. Because as a losing trader before, when I started out the first 2 years, I wasn't making any money. I was consistently losing money, and the majority of my trades were losing trades, and that would frustrate me because I wanted to build a strategy that is right more often than not. Because a lot of people say it doesn't matter whether your win rate is low or high, but if you have a strategy that is right only 30% of the time, that means that 70% of your trades are basically wrong or will lose you money, and that's not the kind of system that I want to trade. But nevertheless, let's continue with the next trade, which is right here. Immediately after that, we have a winning trade, and this trade is not really obvious, so I'm not going to do it. It's not a very clear breakout, but so far we have 3 trades, and I think that's pretty much it for 2024. So basically you had 3 trades, 2 winners and 1 loss. So the next stock that we will analyze is Axon Enterprise, and as you can see in the beginning of 2024, if we take a look, we can see that the stock was up above 51%. So that's perfect and it meets all of our criteria. So let's go ahead and see the whole of 2024, and now we can start drawing our trades. So the first trade that we could have taken is this one, which was a winning trade. The next trade maybe was this one, but I'm not going to count it, because it went up massively the next day and it would have been really hard to count, so I'm not going to count it. So the next one is this trade right here, and this trade is a losing trade, because if you bought here, the stock would have eventually hit your stop loss and you would have been out of the position with a small loss. So the next trade that I can see is this one right here, and this trade was clearly a winning trade. The next trade, perhaps this one. No, because it once again it gapped up massively, so it would have been hard to buy it, but we entered here anyway. And then the next trade is this one, and this trade clearly was a winning trade. And then the last and final trade, I believe, is this one, but this one also, it gapped up massively, so I'm not sure whether you would have been able to buy it, because I like to buy in this area right here. I don't like buying stocks a little bit too late, but nevertheless, let's not count it. I think we still had a couple of very good trades. We had a total of 1, 2, 3, 4 trades, from which 3 were winners. So you can see the strategy in real life action. It's very, very profitable. So yeah, I hope this is very clear.